Here. This is the weekly review. It's May 17th. And let's take a look at what happened in these markets. Starting here with the numbers, you can see that pretty much the S&P was down on the week, 2.25%. The small caps really were ones that took the hit, and we saw that in a number of ways, whether it be banks, financials, real estate, whatever. Gold up on the week, trying to break out again. Junk bonds down, treasuries up, and the dollar up. Year to date down 11% on the S&P, down 25% on the small caps. S&P and small caps, of course, the weakest. If you look elsewhere, right, the new winners, the new world order, it's the NASDAQ, it's technology. Gold still a nice gain on the year, as well as the treasuries. You got junk bonds down quite a bit still, and the dollar has actually had a pretty good gain. Let's look at the technical picture here, and I want to try to give some context today, because sometimes it's easy to kind of skim over what's really happening. If you look at this, right, the swing point low was here, and this is the NDX, and it's on a weekly. We got to that swing point low, we busted right through it. It didn't even phase this market, right? Got up to it, tested on this bar, and then blew right through it on that bar, and now has moved all the way to the high of the breakdown bar. And so if you go back and look at it, there were two breakdown bars along the way. One was this one, right? This one here, and then the second one was here. And those two breakdown bars define that big fast move down that added 25, 30, 35% losses on this market. On the way back up, most of them are stuck here, and we'll see that on the next slide. NDX all the way back to the last gap up before you make new highs. And so to put that in context, here's the S&P. Very different picture, right? S&P, here's the same breakdown bars. So here's the gap up breakdown bar that the NDX is at the highs right now. That's up here. On the S&P, we're just trying to get back over right there. We're trying to get back over that move from these lows, right? So we're trying to get over this second of the two breakdown bars. Now, it did get over the retest regen. That's bullish, but it's struggling, and I don't have the daily up here, but it's struggling at a high volume anchor bar on the daily. It got over last week, that retest regen zone, right? That was the bearish retest regen that it broke over, and then this week it's back into it. Now, keep going down the food chain. Here's the equal weighted S&P. So again, breakdown bar, here's the top, the gap area, the top of the first one, here's the second one. What has this one done? It's barely got into it, right? And if you take an equal weighted, right, the retest regen zone, the bearish retest regen zone starts up here. We haven't even touched it. We haven't even tried to test it yet. This is equal weighted versus the weighted, which was the prior slide. So a huge difference in the way you look at this thing. And then if you go over developed markets and you look at the developed markets, here's the bearish retest regen zone. The low is there. And so this is all the developed markets x the US. Here's the two breakdown bars, the gap area on the first, the gap area on the second. Hasn't even tested the top of the breakdown bar yet. And clearly hasn't even gotten close to the bearish retest regen. So if you look at it and go back, right, you kind of got NDX leading everything, and then you have the S&P, or the NASDAQ's below that, and then you have the S&P below that, and then you have the developed markets underneath all of that, right? And so it's equal weighted actually, and then developed markets below that. And so it's a pyramid, if you will, right, with the NASDAQ on top of the pyramid and the NDX itself. If I look at the technical picture and I break it down now to a daily and say, okay, what does this NDX look like? I can't really get bearish looking at this picture, right? It's a stair step higher. You get up, you come back, you retest. What do you retest? The previous highs. Here you break out, you come back, you retest. What do you test? Previous highs, buyers there. Same thing here. You get up, you come back, you're still testing the previous highs, shoot up again. What do? You come back, you test them again. This is stair-stepping up. This is like picture perfect, whether you're looking at classical, neoclassical, either one, it's the same picture, right? Bullish. If I look at the S&P, a very different story now. If I do that same thing, here's the prior highs. Everything looks the same here on the NDX and the NASDAQ, as well as the S&P. But now we break up to the next one, we come back. We don't even get back to here, right? But we can't get higher. We have divergence, right? On the S&P, you know, we have divergence here. We haven't been able to get over the previous high, whereas on the NDX, we've actually gone to new highs. It's a different story. It's a different picture, depending on which index you're looking at. And so when I'm looking at this and saying, okay, are we going to be able to break this thing higher? It's possible, right? It's also possible that this could break down. It's either way, right? We've got this little zone up here. Now we've got a little higher zone. If we duplicate that zone, it's going to take us up into this area, and we'll see that on the next chart, which is the swing point high. And so we've kind of got this stair-stepping going on, but we've kind of like stopped and started going sideways. And we've done that for about 6 weeks now, all the way from back here, which was the first week and a half of April, up until now. So about 6 weeks of sideways consolidation. The news flow, if you look at all of this and you try to put it in context, right, the news flow is just overly bearish. I mean, everything I see is just bearish, 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 right? Buffett dumps all of his stocks. Buffett never dumps stocks, hardly, right? But he decides that he's going to blow out of everything. He blows out of all his airlines, blows out of Goldman Sachs. This is a big negative, right? When Buffett starts selling at the bottoms. If you look at all the billionaire hedge fund managers, Druckenmiller, you could go through all the list of them. They're all screaming to sell stocks here. And why? Well, you had a huge plunge, and now you have this V-shaped move back up. And they say, hey, this thing's not going to make new highs. Well, maybe it's not, and maybe this is the turn, but maybe it isn't if everybody's saying to sell stocks, right? I always get nervous when I see everybody thinking the same thing I'm thinking. The economic data hugely negative, and that's expected, right? I mean, this market sold off on those assumptions. What is it rising on? Well, we could debate that. Of course, you know, I think it's the Fed mostly and government bailouts, but you know, it's a very different picture. The world markets versus the world economies. This entire rally is all looked at as a fluke. Right? Yet these stocks don't sell down. The most cruel twist would be everybody saying to sell right here. And what does it do? Inches up a little bit more and takes them all out, right? You take them up to take them down. And so nobody in the right mind is thinking that this market's going to move higher. Even I have a hard time thinking that. But if you go back and you look at those charts we were just you know, going through, well, you know what? It could do that, right? We could see the NDX push up to the highs, fill that gap, and we could see the S&P push up to 3,100. Technical picture. Here's what I'm thinking. You know, you got these two ABCDs. One pushes to 3,133. The other one pushes to right at 3,000. This is the small one. There's the larger one. And what do you have? You have this resistance here, right? That's holding there. We've been eating into that supply line for a while now. It wouldn't take a lot to push it over, break a swing point high, get a little juice up, get back into this resistance supply line, right? And then potentially turn it all. So you might take it up to take it down. You got these two ABCDs still on the way up. Now, last week, you know, I talked about the winners, you know, in this new world order, but there's also losers, right? And I want to bring up the losers. I did the same sort of work that I did last week, presented to you. I did it on the losing side, stocks that are hitting new lows. So I took everything from the March 23rd and said, what stocks are lower than the March 23rd as of Friday? And there's 350 of them. Group those into industries. There's roughly 26 industry groups. 75% of them fell into 10 groups. I placed those in a watch list. You can go see them, new lows, and you can take a look at what those are. The idea is the same, right? Is that it's going to congregate in certain industry groups. And if you look at it, 17% of them were in the banking sectors. Another 12%, which adds up to roughly 30, it was almost 12 and almost 13, is in REITs. And so these are the two main sectors that are losing, and then energy is right behind them. Retail and apparel, these are not things that you would not expect, right? These all look to be the same sort of things that you would probably expect. The only one that kind of stood out I didn't expect was medical devices, but mainly it's the facilities, medical facilities. You've probably heard about some doctors getting laid off because we stopped doing elective surgeries and so forth. And so the facilities themselves are hurting. But these are the groups. Another group that's bad is insurance. I wouldn't probably be shorting into the software, the basic materials, or the drug related or biotech. Those are just anomalies, just like we had some anomalies in the last one. So that's what it looks like. If I look at those and just break them down into the groups, here's those groups. And so I put them all on one page for you so you could look at them. And if I go to some examples, last week, during the week, I believe I talked about Sienna. These are some things, these next two are the couple of trades that I made this week. So I bought Sienna, got a nice big boost up on Friday. It's up here testing the new highs. If it breaks over, right, you can get its ABCD structure to the upside. And then I would probably want to take some profits, right? So you buy these things thinking that they can move higher. Here's another one, Natural Grocers. It happens to be a place I shop a lot. They had this huge spike up, 40-something% on earnings here, big volume bar. Usually when you see this neoclassically, it's going to hold price in this range for a good period of time. And so I flipped it twice already. I buy a big chunk of it as it comes back towards the lows of this little range. And then I just flip it back in towards the highs. I flipped some again on Friday. I didn't get as much as I wanted, but I'll take what I can get. You flip these things back and forth. If it goes lower, right? If this breaks, almost certainly going to get bought down here because it's more than 6 bars and it's a high probability move. So does it make sense to buy here? Well, yes, because you can trade that range, that higher range. I doubt seriously that it's going to break up higher, but there's a big range. These are large ranges. These are, I'm seeing 10-15% moves here, even though it looks small on this chart. So they're playable. If I go to the losers, here's an example of one of those, CNA Financial. This is insurance. If you look at this thing on the way down, you got an ABCD structure to the downside and just completed, right? So as it bounces back up into this range, it's probably a short. Now the shorts are harder because you've got individual stock risk. In other words, something could come along and shoot this thing up higher. So you could look at just the industry groups themselves, right? Because there's an insurance KIE is an insurance sector ETF, and you could short the sector. Not going to get as big a move, but again, you could play it safer if you want to instead of trying to pick out the individual names. And so here's an example of that as it comes back into here, eventually probably going to trade back down into this area. What would cause it to come this deep? Well, if the market itself rolls over. We're already saying that we're probably not going to roll over this week, or at least I'm thinking it's not. You'll see that prognostication here in a bit. But if it were to push back up into here, it's probably not a bad sell. It's probably a good place to short and look for it to move lower. If the market does roll over a week or two out, then you could actually get a larger move to the downside. But it's a way to play this market. So there's simply, the bottom line of all this, simply too much money chasing stocks. We said that last week, and it's going to continue to be true. The focus to me, and I started talking about this last week, you sell the bounces, you buy the dips, right? And so if you're long, you go long, if you're short, you take gains. Let's say it a different way. If you're long or you want to be short, right? if the market pushes up, you take your profits on your longs and you initiate your shorts. As the market moves down, you take your profits on your shorts and you initiate your longs. Which way do you want to be? In my mind right now, they're roughly equal. I don't have a huge bias to either side. I think the downside is going to be the bigger move when it finally comes, but until it comes, it doesn't matter. And so you just trade this range a little bit longer, right? And if you're in the sectors that are in favor on the long side and on the short side, right? No matter which way this goes, if we go to the downside and we break the little small ranges that we're in, we're just going to set up a larger range. And so even if that happens, just like we were looking at the charts a while ago with Sienna, with natural grocers, if it comes into the lower range, you just buy the lower range. And so, yeah, maybe you make some money once or twice and then you get caught in some of it potentially. Well, you just buy it deeper. Your average price ends up here, and when you get your bounce back here, you'll make your money again. I don't think we're going to see this market trade to new lows on the general market anytime soon. It's going to take it a while. It's going to take a while to build out that range. And so that's the idea. You do the neoclassical theory, right? Buying and selling those ranges. What's the bottom line? Same thing we've talked about, right? You've got this fear of missing out that's driving it. You got the central banks, government bailouts. On the flip side, you got some massive supply shocks and what looks to me like maybe an 85 to 90% recovery. In other words, I don't believe this market's going back to where it was. You know, where if the supply, if the what am I trying to say? If the demand level, right, GDP, if you want to, whatever you want to look at, right, if you look at GDP, if it used to be here, it's down here somewhere, and that difference is probably 10-15%. So we're not going back to where we were, and we're not going back to where we were in terms of sectors either. It's going to take a long time before this market really recovers, even though it's having a nice run. We're going to print a high at some point, and then this market's going to eventually roll back over and it's going to make new lows. These opposing forces, they're going to continue to oppose each other. At some point, we're going to get this high, but it looks to me like this is starting to set up more like it could squeeze higher before we go lower. All right, let's quickly get through this fundamental stuff. A little bit better than expected on some of the news. You know, the 85-90% capacity is what I was just talking about. We got $2 trillion of Treasury issuance over the next 45 days. Who the heck's going to buy it? I mean, China's already got, you know, this animosity that's going on. I just don't know who's going to buy this stuff. And, you know, if the Fed's going to come in, usually the Fed's forced to buy it. In other words, that kind of money. You know, are they going to do another QE for $2 trillion? Well, yeah, they will. If what? If the market sells down. And so maybe that's what causes this. What if we get more infections? That's what everybody's thinking is going to happen. Is going to move this market down, but so far it hasn't happened. And the other thing that started happening is the trade wars. That got kicked into high gear again. Next week, the most important data, I think the FOMC minutes are going to be the key thing. That's where I keep my eyes peeled and see what they show up. Earnings, they're done. Last week, my expectations were that we, you know, the general expectation is that we trade the swing point lows and then we'd bounce and then we'd get a failure. Well, we didn't get the failure, we got the bounce. But that is more than likely what happened. It was the closest thing to what actually took place. Here's this week. What do I think? Well, we could go up and blow out those two ABCD structures to the upside. I think that's best case. More likely case, I think they're going to squeeze it higher. I think they're going to go up here and take out that one ABCD structure that's up there around 3,000. And if it was worst case, you know, if we do, I think that would be a break of this swing point low. It would take us into these and may or may not break them. And so that's the way this shapes up where we're at. I want to thank you for being there. Be safe. It's a nasty virus. I've heard from a couple members so far that have actually had it, and it is a kicker, even for healthy folks. So do your best to avoid it, and I'll see you next time.